Last minute inheritance tax planning. Inheritance tax, variously called the voluntary tax, much derided by many. I often hear ordinary people say, "I've paid tax all my life, why should I pay it again?" And for many people preparing to mitigate against inheritance tax, legally of course, it can be a major challenge, as most of us need to retain the use of our assets during our lifetime to provide us with an income and financial security. But what can be done if illness besets us suddenly and there's still a desire to reduce the amount of tax paid? One answer to last minute inheritance tax planning is this. If there's a lasting power of attorney in place, many people think there is nothing that they can do to plan for inheritance tax. This is because making gifts can be very limited without the approval of the Court of Protection. The Court of Protection's view is that giving away assets during your lifetime would not be considered as being in your best interest. This can make it difficult to plan for passing on your wealth tax efficiently. So what can you do? So let's imagine that you have total assets of 1.5 million and you've already been widowed. Because you were previously married, you have a total nil rate band of £650,000, and that still leaves you with an inheritance tax liability of £340,000. You have put a lasting power of attorney in place should anything go wrong, but you don't want to gift assets away as you feel you need to retain the use of your assets for the future. Imagine the worst thing happens and you lose capacity and you're no longer able to control your affairs. The circumstances in which gifts can be made from your estate without a Court of Protection approval are likely to be very limited. In fact, any gifts made will take 7 years to be fully outside of your estate for inheritance tax purposes, by which time it may be too late. So your attorneys decide they must take action. Your attorneys need to ensure that any investment decisions that are made are in your best interest and what will not disadvantage you, for example, by making your money inaccessible. So one possible solution is as follows. Your attorneys decide, upon the advice of a financial advisor, to invest £350,000 on your behalf into a business property relief investment. This investment, or these investments, are made in your name, meaning you retain full ownership of the investment. Once the investments have been held for a minimum of 2 years and owned by you at the point of your death, the investment should fall out of your estate, saving your beneficiaries an inheritance tax bill of £140,000 upon your death. It does not entirely eliminate the liability, but it is still an improvement. By using this type of strategy, there is no life insurance requiring medical underwriting. There is no requirement for 7 years survival after making the gift. In addition, if necessary, withdrawals can be made at any time without jeopardising the plans to mitigate against inheritance tax. Furthermore, some of the business property relief investments now available to investors are towards the lower end of the risk spectrum and are only targeting low investment returns. They're not looking to make high returns, and preservation of capital is important. So my name is Martin Dodd, and I look forward to talking to you once again about financial and tax planning issues.